In this presentation, we will take a look at audit assertions and substantive tests related to inventory. Recall in the process, as we go through the inventory process with relations to the audit of inventory, we're considering the inherent risks, then the control risks. We set the inherent risk and control risk, see if we can depend on the controls. Then we think about the substantive procedures and thinking about how many substantive procedures or how much detection risk we need to have. And that's going to relate to the substantive procedures that we will be doing. That's what we're considering here. We're considering those assertions and the substantive tests related to inventory. Recall that when we think about substantive tests, those are the ones that we would probably first think of as actually basically the most primary audit type thing that you would think of, going out to the business, actually digging through types of items related to inventory, observing inventory, those type of activities related to inventory. First, we're going to consider assertions about classes of transactions. So we're considering inventory, assertions about classes of transactions, assertion of occurrence. Inventory transactions, events recorded or disclosed have occurred and are valid. So remember, occurrence, you're saying these are the things at the end result that are shown here. You can consider the financial statements in general, and then think about, did these things actually occur? Are they representing transactions that actually happened? The transactions and events relate to the business. Of course, we're considering transactions that not only actually happened, but they relate to the business on which the financial statements are being reported. And then we have the assertion of completeness. Completeness, inventory, and events that should have been recorded have been recorded. Again, completeness basically going the other way. Is there, if you think about the end result, is there anything that should be in the end result that is not in the end result? That's the general consideration with relation to completeness, opposite in essence of occurrence. Related disclosures that should have been included in the financial statements are. And then we have the assertion of authorization. Inventory transactions and events have been correctly authorized. So do we have the correct authorizations for the transactions that are taking place with regards to inventory? Classification, next assertion. Inventory transactions and events have been recorded in the correct accounts. So obviously classification, have we classified the correct accounts with relation to the inventory transactions? Continuing on to the assertion of accuracy. Accuracy, amounts and inventory transactions related to data and events have been recorded correctly. So do we have the correct recording with relation to accuracy? Rated disclosures, related disclosures have been properly measured and explained as well. We then have the assertion of the cutoff. You're thinking about the end of the year cutoff. Typically, I would imagine in your mind the 12/31 year end, as if we have a calendar year end and we're doing a 12/31 year end cutoff then, 12/31. Inventory transactions and events have been recorded in the proper accounting period. So should they be recorded before the cutoff date, before 12/31 in the year we are auditing, or after it? Should they not be recorded after the cutoff date, given the circumstances, given the regulations, given the accrual principles? Then we have the assertion of presentation. Inventory transactions and events are correctly aggregated or disaggregated and clearly described. Related disclosures and are relevant and understandable. So the disclosures are relevant and understandable. We're going to now continue on with the assertions, but this time discussing them about the account balances. So we're going through these assertions now related to the account balances with regards to inventory. So occurrence. Inventory recorded on the books actually exists. So occurrence, the inventory actually exists, of course, is what we were looking for. And then on completeness, inventory related to accounts that should have been recorded have been recorded. Related disclosures that should have been included in the financial statements are. So again, when we go back to occurrence, we're basically thinking, are the items, the inventory recorded on the books, the end result, should they actually be there? Are they actually there? Completeness, on the other hand, inventory related to accounts that should have been recorded, have they? Of these two, we're probably more concerned with occurrence, because why? As auditors, we're more skeptical that the financial statements will be overstated, that they'll look better. We don't want to overstate the financial statements, so we're more concerned about inventory, an asset, something that would make them look good, being on the books when they don't actually have it. And therefore, we're probably more concerned here, we will be generally, with the occurrence than completion, although we want to test them both. Accuracy, valuation, and allocation. Inventory accounts are included in the financial statements at the correct amounts. Any valuation or allocation adjustments are properly recorded. Related disclosures have been properly measured and described. Then we have classification of the assertion of account balance. Inventory is recorded in the correct accounts. Next assertion is completeness with relation to account balance. Inventory accounts are properly aggregated or disaggregated and clearly described. Related disclosures are relevant and understandable. Now we're going to consider the substantive analytical procedures. So we got substantive procedures. Those are the things different that we're not testing the controls now. We're testing the substantive testing. However, we're concentrated here on those analytical procedures. And anytime you see analytical procedures, what I picture is the auditor being cozy in their little audit office, in their home office, their office, rather than the client's or the business location. These are the substantive tests. Unlike what probably comes to mind most of the time with substantive tests, is us going out there counting things, looking at inventory, pulling invoices. These are the things we do nice and cozy in the audit office at home, at our office, and we can just do analytical procedures, testing things using ratio analysis. So that's going to be the substantive analytical procedures. We're going to compare inventory turnover to previous and industry averages. So we got ratio analysis, of course, with relation to inventories, one of the things we can do within our substantive analytical procedures. Observe slow moving or excess inventory is what we're looking for with regard to that analytical procedure. The next one, compare days outstanding in inventory to previous years and industry average. So we're looking at those ratio type of analysis that we've seen when we analyze the financial statements in general with regards, of course, to inventory transactions. Observe slow moving or excess inventory with that type of comparison, that type of ratio analysis. Next, compare quarterly gross profit percent by product line with quarterly values in previous years and industry. So again, comparing to the industry and previous year. Under-recorded or fictitious inventory is something that will be considering with regards to that ratio type of analysis or comparison. Compare actual cost of goods sold to the budgeted cost of goods sold. So we'll compare the cost of goods sold numbers, of course, with regards to inventory transactions. That's going to give us the over or understated inventory or give us some understanding of it, or that's what we are considering looking further into with that type of analytical procedure. Compare current year's standard costs with the prior years. So that's going to be detecting over or understated inventory. And then we're going to compare quarterly actual manufacturing overhead cost with quarterly budgeted amount with standard overhead costs. So remember, the standard costs are kind of like the budgeted type costs. If we're usually thinking about a production type company that produces the inventories in those cases, then they will have that standard cost. We can look at those differences, those variations. Inclusion or exclusion of overhead costs is something that we will be considering there. With regards to standard costs, when we're auditing standard costs, is what we'll be considering here. Now remember, standard costs are something that will be used when we're producing inventory. If we're making inventory, then we typically break things down into standard costs, and we call them standard costs. You can think of them kind of like budgeted numbers, but we break them down a little bit more detail than budgeted numbers, because budgeted numbers, we usually think about those numbers that are actually on the financial statements, like cost of goods sold, inventories. The standard costs, we're going to break them down into their component factors. So when we think about something like the inventory, we've got the labor that's involved in the inventory, and then we can break that down even further to the components of labor, which includes the wage rate. So we're going to have standard costs, which relates to the standard or budgeted wage rate, and the number of hours that are going to be used. The number of hours and the wage rate are not on the financial statement, but there's something that we could break down into further detail with regard to standards costs, so that allows us better variance analysis. So these are types of things specific to manufacturing type companies. If you're not in a manufacturing type company, something that's making inventory, then you may not be dealing with this much type of complexity, even if you have inventory, because you might have inventory related to just purchasing and selling of it. So materials standard cost. Test the quantity and type of materials included in the inventory. Test the price of the materials. So obviously we're going to be considering the standard cost and the actual price of the materials that are in the production process. Overhead. Review the entity's method of overhead allocation. Recall that overhead is something that we're going to put into basically the bucket because we couldn't apply them to a job or a process. I'll usually consider a job cost system when I consider the making of type of items, because it's easier to think of overhead not being able to apply to a job in my way of thinking. But the same thing is with the process. So we put them into overhead. Then we need to allocate them to the inventory in some type of way. We need to test then that allocation process for reasonableness, compliance with GAAP, generally accepted accounting principles, considering or assuming that we are testing the financial statements to be in compliance or in accordance with generally accepted accounting principles, and consistency. So obviously when we apply some type of method, it needs to be consistent. Labor, generate evidence regarding the type and amount of labor needed for production and the labor rate. So when we're considering labor, there's two components, of course. One, the amount of time needed, and two, the rate. So we want to consider those two items. Then we want to consider the physical inventory. So note, obviously, when we're considering inventory, it's a physical thing. It's something that we can go out and look at. And this is going to be one of the major procedures that any new auditor gets to usually go do, because it's pretty easy to go do, and you have to go out, and it's kind of a fun thing usually for new auditors to go out and count the inventory. So we get to go out and count the inventory. So it's physical. We want to observe the inventory in some way. Auditor will do the following at the observation of the physical inventory. So we want to actually go out, look at the inventory, because that's going to give us some evidence of the physical inventory. Now, again, obviously, when we go out and look at the inventory, we can't look at all inventory. What we can do is do some type of sampling and do some inspection of the inventory, at least considering the type of inventory. If you have some kind of company that makes very few things, but they're really expensive, maybe we can observe all of them. But if you have types of inventory where there's a lot of things and not that expensive, then we'll have to consider how can we do some type of observation to verify the inventory, some type of sampling method in order to do observation. So make sure that no production is scheduled. So when we do the physical inventory, when we go out there, look at the inventory, we don't want the production to be running at that point in time, because that's going to confuse our count of the physical inventory. So we would like to be out there and say, hey, we don't want the production process happening at this time. Can be a nuisance, because obviously if you're working with an industry that's producing all the time, then we would prefer not to have the production, but it will make the audit process easier. Now, if production is going on, then controls need to be established for movement through the department to prevent double counting. So that's mainly what we want to not happen. If the inventory is moving through, we want to make sure that as we count things, we're not going to double count or mess up the count, given the fact that things are moving through the process. Make sure that there is no movement of goods during the inventory count. Ensure that the inventory counts teams are following the inventory count instructions. So we're going to have specific instructions that are planned out in order to do the physical count. So we're going to think about what type of physical count do we need, which inventory items are going to be counted, how can we basically sample which items are going to need to be counted so that we can go out there and follow the rules of the instructions we have set up. Because, of course, those instructions have been set up so that we can count in such a way that we get an idea of verification through some type of sampling method that that the whole population is indeed present in terms of the inventory. And the way we're going to set up that inventory count will differ depending on the different types of inventories that we are dealing with. Make sure that inventory tags are issued sequentially to individual departments. Perform test counts, recording a sample of them in the working papers. And of course, this is the primary task of many new auditors out there, so we get to actually count the inventory. And this is kind of a fun thing a lot of times, because you actually go out there, you might go out there when the company is actually counting the inventory as well. And you'll have to go out there and say, I'd like this certain piece of inventory. And it might be something that's easily accessible. It might be something that's way back in the warehouse, and poor industry people have to go back in there and pull it out. It's up in the top shelf over there, get the forklift out and pull it out. And it's also the case that you may be counting this information when it's just been counted. So the people that are working there might say, hey, I just counted it. It's right on the box. You can see right there, it's got 25 of these inventory items in there. And you got to say, well, no, I'm counting it again because that's what I have to do here. That's my job as the auditor. I've got to recount this thing and put it into the working papers. And of course, normally we would expect the physical count on the box to be correct. We just need to check them with an observation at some point so that we can sample these items. And then once we have that sampling process, we can apply that to the population and give us some assurance that the whole population is there. So that's our evidence that we're putting together. Obtain tag control information to test the business inventory compilation. Obtain cutoff information, the number of the last shipping and receiving documents issued. And this is going to be important, of course, because we want to make sure that we have that cutoff information with regards to that cutoff testing, because that's one of the areas where errors or if there was fraud or some kind of manipulation could take place within the manipulation of that cutoff date. And when we think about inventory, usually the shipping documents are the things that tell us the inventory information. So the stuff that is coming to us, typically when should we be recording it as inventory? When the shipping documents happen, when we got it typically. And when should we be recording the inventory as not ours anymore on the sales side of thing? Typically when the inventory is leaving. So that cutoff information towards the end is going to be important. Observe inventory condition for items that may be obsolete, slow moving, or carried in excess quantities. So as we consider the inventory that we might be checking, we might try to check some inventory that might be considered obsolete in some way, or think about how could we test for items of inventory that might be obsolete. And when we check it, if you say, hey, I'd like this piece of inventory, and it's just basically old stuff that's way in the back that they can't even get to, they pull out the inventory and it's basically 20-year-old kind of stuff, obviously, we got to think about how old the information is, how old the inventory is, and then think about how we can value that inventory. Now, remember that we can look at it in the physical count as auditors and say, hey, this looks kind of old here. But we might need some other opinion then to determine what the value of that inventory will be. It's because if we're testing things like some kind of clothes or something like that, if they're old clothes from the 70s or something, you could still say, well, they're still new, but they're from the 70s. We'd have to somehow value what the clothes will be. And depending on the industry we are in, we'll need we may need a professional to come in and say, what's the current market value, if any, of this older inventory items, and how can we determine that or test for that? Inquire about goods held on consignment for others. So consignment goods are always an issue where the holder of the goods, possibly we have inventory that's being held in the warehouse that aren't actually the inventory of the company, but are being held on consignments. We need to be aware of those type of conditions as well. Now we'll consider transactions, test of details. So test of details with regards to occurrence. We're going to vouch a sample of inventory increases to the receiving reports and purchase requisitions. So recall occurrence, we're thinking the end product, did the actual transaction happen? So with the transaction that has been recorded, we're going to look at that. And then we're going to vouch a sample of inventory increases, the things that actually happen in terms of transactions, or the things that are recorded, to the receiving reports, the triggering factors that should have caused those things to happen, to see if the occurrence is there. Completeness then, the testing of completeness, we're going to trace a sample of receiving ports to the inventory records. So in this case, we're going to go from the source, the receiving reports, the thing that should be triggering the inventory, and trace them back to the end product, the reporting item. So occurrence, completeness. And then we have the authorization. Test a sample of inventory shipments to make sure approved shipping ticket and customer sales exist. So to make sure the authorization is present. Accuracy. So testing for accuracy, we could recompute the mathematical accuracy of a sample of inventory transactions. So we can recompute them, of course, for accuracy, always a good time. And then we can audit standard cost or the methods used for price inventory. So if there's using standard cost, again, if we're making the inventory, we can use those standard costs and look at those calculations, something that can be a bit more complex if we're doing the production process of inventory rather than just purchasing and selling. Then we have the cutoff. Trace a sample of time cards before and after period end to correct weekly inventory report. So cutoff, big deal with regards to inventories. We want to make sure that the cutoff is proper. In essence, we're thinking about the cutoff in terms of the end of the time period. You could think of it if it's a year end, 12/31. Also note that we've thought about the cutoff with regards to the sales process, because when we think about sales, of course, we're thinking about the inventory leaving, and we've considered the cutoff to some degree with the purchasing process, because obviously when we consider purchasing, inventory is one of the things we purchase. So there's going to be some overlap, as we've discussed before, with the testing of inventory and some of these other items. Cutoff, very important with regards to both of those sides of the transaction, both the side of us purchasing and the side of us selling. the inventory, because those are places where errors can happen. Those are places where manipulation could happen if there was manipulation to take place. Classification. Examine a sample of inventory checks for correct classification into the proper expense accounts. So we want to take a look and make sure that the classification is proper. It's being classified to the proper accounts. And then presentation. Review disclosure checklists and related disclosures for relevance and completeness. Next, we have test of details related to account balances. First, the assertion of existence. We can observe the count for the physical inventory. So when we think about existence with regards to account balances, obviously that's going to be part of our physical inventory count. And then we have completeness, where we will trace test counts and tag control information to the inventory compilation. Then we have rights and obligations, where we will verify the inventory held on consignment are not included in inventory. So inventory held on consignment that we're considering rights and obligations shouldn't be included in the inventory. Inquire of management about warranty obligations. Warranty obligations is going to be another concern with regards to rights and obligations, and they could complicate things. And then we're going to inquire of management and review any loan agreements and board of directors minutes for indication that inventory has been pledged or assigned. So what if there's a fact that the inventory has pledged or assigned in some way? We need to get some indication from that. We're going to inquiry management about that. And then we're going to take a look at any kind of loan agreements that might be in place, as well as scan through the minutes and looking specifically for any kind of assignment of the inventory in any way that would violate or change what we would consider to be the rights and obligations related to inventory. Then we have valuation and allocation. Obtain a copy of inventory compilation and agree totals to the general ledger. So we're going to get a copy of the inventory compilation, and then we're going to consider that and agree that to the general ledger amounts, the end amounts related to inventory. Then we're going to test for mathematical accuracy of extensions, inquire management about obsolete, slow-moving, or excess inventory. And this is always something that we have to basically use our best judgment on with regards to that slow-moving inventory. Does it need to be reduced in value? So we'll have inquisition about that. Review book to physical adjustment for possible misstatements. Book to physical adjustment, you will recall that typically we're thinking that the inventory is going to be on a perpetual inventory system. It's going to be updated as we go, which will typically be the case in a more sophisticated type company, as opposed to what you'll recall as a periodic system, where we count the inventory and are completely kind of reliant on the count to determine how much was sold. In a perpetual inventory system, we're still going to do the physical count. The company will still do the physical count from time to time, and they'll make any adjustments they need to make, and the adjustments might be due to something like spoilage or theft. So we want to think about those type of adjustments that will typically happen where they did a physical count and they adjusted the inventory to the physical count. We could think of it happening weekly, monthly, daily. So we want to look at those adjustments and see if there's any large adjustments. If there's a large adjustments often to the physical count, to a system that should be on a perpetual system, then something funny is going on. There's theft happening, or something's wrong with the perpetual system that's not recording properly, which of course increases the risk and makes us look into it more closely. Classification. Review inventory compilation for proper classification of raw materials, work in process, finished goods. Obviously, when we're thinking raw materials, work in process, finished goods, we're thinking about inventory processes for a manufacturing type of company, which will be more complex with regards to classification, because we'll have to track the inventory through those component parts: materials, work in process, finished goods. And then we have the presentation. Review disclosure checklists and related disclosures for relevance and completeness. Review inventory purchase contracts for correct disclosure of long-term contracts, related party transactions, and assigned and consigned inventory. Determine if cost method is disclosed correctly. So you'll recall the cost methods that we could have. We could have specific identification for large inventory, where we specifically identify like a car by license plate number. We can have first in, first out, where we assume a first in, first out just as an assumption, cost flow assumption, last in, first out, weighted average methods. We're going to continue on with account balances, test of details of transactions. Auditor will investigate large adjustments between the amount of inventory shown in the general ledger account and the amount calculated from the physical inventory account for possible misstatements. So once again, if we see that big adjustment, if there's big adjustments that are being made, if you're in a perpetual inventory system and then you still do a physical count, and the perpetual inventory system the physical count should just confirm that the perpetual inventory system is doing right, that the inventory is what it should be at the end of the books, with small adjustments related to small types of things. If there's large adjustments adjusting the perpetual inventory system to the physical count by the company, then there should be some investigation into those items because something funny happened. There are possibly spoilage, possibly theft, possibly some kind of miscalculation with regard to the perpetual inventory system. All concerns that we want to look into. Possible causes of differences could be inventory cutoff errors. So maybe it has to do with a cutoff testing type of error, and that's the reason for that. Unreported scrap or spoilage. So possibly there's scrap or spoilage or theft. So those are going to be the typical kind of things. If you're going to say, hey, the physical inventory is actually lower because I counted it than the perpetual inventory system, well, possibly that would be because something happened that didn't get recorded that reduced the inventory. What would that be? Oftentimes you would think that spoilage might have happened, theft might have happened, although there could be some kind of inventory cutoff error, some type of timing difference as well. Now we'll consider disclosure items with regards to inventory. So these are the items that are going to have to be disclosed. So we have the financial statements and then the disclosures. So we want to disclose the cost method. The cost method being something like specific identification, LIFO, FIFO, or the weighted average method typically. Then we have the inventory components. So what are the components of inventory? What's making up the inventory? Then we want to see the long-term purchase contracts. If we have any long-term type purchase contracts, then that locks the company in some format. We want to see that in the disclosures. Consigned inventory. Consigned inventory always has that kind of issue with who actually owns the inventory. That should be disclosed. Purchase from related parties. Anytime we have the purchases from related parties, we're skeptical about it because we don't have the valuation of the market value in order to judge the arm's length transaction, as they say, of the transactions. We want disclosure on the related parties. LIFO liquidation. You'll recall that LIFO of the inventory flow methods is the funniest one because it's the opposite of what you would expect the company would want as an inventory flow, although it's just an assumption of inventory flows. And so if there's a LIFO liquidation, then that's something that we want to basically consider as well. Now, a lot of companies won't be representing their books with last in, first out, because again, it is kind of unusual, and the time you might be using last in, first out might be for tax benefits, and therefore, so in any case, LIFO liquidation, if you happen to be using LIFO and there's a LIFO liquidation, then that would need to be disclosed. Assigned inventory, so if there's assignments of inventories, disclosures, disclosure losses from write-downs. So if there's substantial write-downs, that needs to be disclosed because that's kind of an unusual thing as well. If you have the inventory, recall that we're going to record the inventory basically at cost. If we purchase and sell the inventory, we're going to record it at cost. Now, if the inventory doesn't sell and it just gets old and we have to write it down, then that could be a substantial difference in one, like a kind of a shocking type of difference. So we need to know that because if you're reading the financial statements and you're looking at inventory from one period to the other, and you're saying, what's something funny about this difference? It might be the fact, well, they wrote down possibly the value of the inventory, which could throw off kind of the analysis. And then warranty obligations. So recall that warranties could adjust the value of the inventory, because obviously when you think about the value of the inventory, the consideration of warranties can kind of skew the value of the inventory that you're going to be calculating. So we want to consider and disclose what the warranty obligations are going to be. Audit findings, evaluation. At the end of testing, the auditor will aggregate all identified misstatements. So we're going to aggregate together the identified misstatements. The likely misstatement is compared to the tolerable misstatement. So the likely misstatement that we aggregate together compared to the tolerable misstatement. And that's what we planned on that would be tolerable for the audit process. If likely misstatement is less than the tolerable misstatement, the auditor may accept the inventory account as fairly stated. That's what we're hoping to happen. However, if the likely misstatement is greater than the tolerable misstatement, the auditor will conclude that the inventory is not fairly stated. That's what we're hoping does not happen.